Okay, so let's start at the beginning. How do we form a partnership? First up, a partnership happens when anytime two or more people decide to go into business together. So you don't have to actually file any forms with the Secretary of State or with any particular entity in order to form a partnership. So just say Jennifer and I decide that we're going to bake pies and we're going to sell pies, and I have the equipment to make the pies, but she has the recipes that to use for the pies, and she's got the actual baking expertise, and we decide that we're going to go into business together and bake pies. Well, we've just formed a partnership by doing that. So it's super easy to form a partnership, and a lot of people do it inadvertently. They don't actually intend to do it, but anytime you go into business with another person, so anytime two or more people form a business together, they are forming a partnership. Now, you may choose to, those people may choose to have a different type of business organization rather than a partnership, but the default is a partnership. So maybe those two people going into business together really want to have an S corporation. They can do that, but there are steps you have to take in order to do that. You have to file as a corporation under the Secretary of State, and there are certain elections you have to make with the IRS in order to be an S corporation. But with a partnership, that is just the default business organization for any time two or more people decide to go into business together. When you form a partnership, there are different ways that partnership could be formed, and there are different ways that partners can contribute to that partnership. In my example, I said that Jennifer has the expertise and the recipes, which are intangible, and I have the equipment, so I have hard assets. So we're going to get together and I'm going to contribute my assets, and she is going to contribute her expertise. We've each contributed something, but those items have different value. They have a different basis to us when we are contributing to them to the partnership. Now, we probably need some cash too. So Anthony's got cash. He's going to become a partner, and he's going to contribute his cash to the partnership. So we've each contributed to the partnership, but we've contributed in different ways, and our own basis in that partnership is going to be determined by the value of what we have contributed to that partnership. So here we've got an example. Jason and Spence form a partnership to perform lawn care and landscaping. Each of them is contributing $25,000, and in exchange for that $25,000, they receive a 50% interest in this landscaping company. So that means they each own 50% of that landscaping company. If they turn around and sell that landscaping company, they're going to have to divide up the proceeds based on their partnership interest in that. When they contribute that money, it's really not a taxable event. Nothing has happened at that point, because all they've done is they've transferred $25,000 each of them from their checking account into the partnership. It's kind of like buying a stock, right? No tax event has really happened, but what has happened is you've created a basis in that ownership percentage. So, but there's no gain or loss recognized from contributing money to that partnership at that point. So, basis, and like I said, it's the same general concept of the cost of an asset, and we're talking about an asset here, but it's a little bit different with partnerships because, like I said, we have two types of tax basis for partnerships. We have an outside basis, which is the basis of the partnership interest in the hands of the partner, and an inside basis, which is the partner's share of the basis in the individual assets of the partnership. So we contributed that $25,000 that each of them contributed. So now the partnership itself has $50,000 of assets. Right? They've transferred 25 each. The partnership now has $50,000 of assets. That $50,000 of assets is what would be called the inside basis, but each partner has a share of that basis. So in this case, it's pretty simple. They're 50-50. They each contributed equal amounts, so their inside basis is actually going to equal what their outside basis is. The outside basis is what the partner has contributed originally to the partnership, and then that gets adjusted from time to time as well. So when a partner contributes property to a partnership, the basis of that property carries over to the partnership. So where I contributed assets, maybe I contributed an oven and some, I don't know, what else would you need? An oven, a refrigerator, some different kitchen utensils and things. And in total, my basis in those tools and equipment was $10,000. So when I contributed property to that partnership, the basis of the property carries over to the partnership. So now, with the inside basis, my basis becomes the partnership's basis. So it was $10,000 to me. Now it's $10,000 to the partnership. The partner's basis will increase by the basis of the property contributed. So my basis in the partnership also happens to be $10,000 because that's the basis, that's what I contribute, the value of what I contributed. So, and this is known as basis in, basis out. So it carries over whatever that basis is. Here's another example. We have Bart and Alan. They form an LLC, so there's that LLC, to construct personal residences. They are 50-50 partners. That percentage, by the way, is determined by the partnership agreement. This is why partnership agreements are really super important. Some partnerships exist without them, but then a lot of business owners will tell you that a partnership, breaking up a partnership can be worse than a really ugly divorce. So it's really good to have everything down in writing and to have a partnership agreement if you're going to form it, even if it's just a simple little partnership, so that everybody understands how much each person owns, what their responsibilities are, what their rights are, so that it's all on the level. So here, each is a 50% partner. They share income and loss. Bart is contributing these assets to the partnership. So his basis, here's his basis in these items. He has some land that he is contributing. Now his basis is going to carry over. The basis to him was $55,000. The basis to the partnership now in that land is $55,000. Now we're not going to depreciate it, obviously, because it's land, but it's going to then transfer from Bart to the balance sheet of the partnership, and it's going to be listed as $55,000. But that land is worth $100,000. So it has a value at the time that it's donated of contributed of $100,000. He also contributed some equipment. The basis to him was $35,000. So because the basis to him was $35,000, now the basis to the partnership is also $35,000. So in total, the basis to the partnership of that land and equipment is $90,000. The fair market value of the equipment, though, is $50,000. So the fair market value, so it's as though he contributed $50,000 to the partnership. So we've got our basis and our fair market value. So that's Bart. Alan is going to contribute these items. So he contributes cash, $90,000. Cash is easy. Basis is the fair market value for cash, right? So $90,000. So his basis of $90,000, fair market value of $90,000. He also contributes office equipment, which has a basis of $30,000, a fair market value of $40,000. I think it's that way. They didn't really. They should do it the same way. I'm assuming that this is the basis and this is the fair market value. And then, although it's kind of weird because, yeah, this would be the fair market value. Because they're 50-50, they're going to look at the fair market value of everything that they contribute. They're going to base their partnership percentage on the fair market value of what they contribute, but that may be different from the basis of what they contribute. Office equipment, basis of $30,000, fair market value of $40,000. A truck with a basis of $5,000, but a fair market value of $20,000. I guess that makes sense. If they each had their own business and that truck had been depreciated, or maybe he took some 179 expense or bonus depreciation on that truck, then his basis is going to be low, but it still could have a fair market value higher than what the basis is, right? That could just be a one-year-old truck, right? So the basis of the items that Alan is contributing is $125,000. The fair market value is $150,000. Okay, so Bart's outside basis, the basis of the assets that he contributes, is $90,000. The sum of the contributed assets basis. Alan's outside basis is $125,000. That's also the sum of his contributed assets basis. But his inside basis, the inside basis for each of these is $150,000, that fair market value. So Bart's partnership basis is $90,000, while Alan's basis is $125,000, yet both own 50% interest because the fair market value, because they had some unrecognized gains in those assets. They have appreciated in value. If Bart were to sell his partnership interest for its fair market value of $150,000, then he's going to recognize at that point a $60,000 gain. You can think of that in terms of if he hadn't formed a partnership and he just sold these assets for $150,000, he'd have to recognize a $60,000 gain, right? At that point, even before he formed the partnership, he'd have to recognize that gain. Well, he's not going to avoid recognition of that gain by forming a partnership and then selling his partnership interest, right? So if he were to sell it and it's worth $150,000, he's going to recognize a $60,000 gain, the same gain he deferred upon contributing the assets to the partnership. So a partner's basis in their partnership interest, which is the outside basis, the sum of money contributed plus the adjusted basis of property contributed. So again, outside basis here is so this is the basis of assets contributed is going to be the outside basis. The inside basis, let me see if I can get the wording right on here. So this is the partner's share of the assets of the partnership. Okay, so in this case, the how much they would get if they sold it at fair market value, how much they would get for their share. So like I said, in this case, their inside basis is the $150,000. Their outside basis is the $90,000 and $125,000. Here we've got Dave and Alyssa form a law partnership. Dave gave $100,000 cash to the partnership. Alyssa gave $100,000 of unrealized accounts receivable from her cash basis sole proprietorship. Okay, so she had a law office as well, but she was just a sole proprietor in that law office, and she's got clients that owe her $100,000. Okay, so she's got this $100,000 of accounts receivable sitting on her books. She's going to transfer those to the new law firm. The new law firm's then going to bill for it. When they collect it, that's what's going to come into the new law office. So she's not going to receive that money. The new law office is going to receive that money. So what is the basis of the partnership interest in each partner? So Dave is going to have a $100,000 basis in the partnership because he contributed $100,000. Alyssa has a zero basis because there's no basis in that accounts receivable until it's actually collected. Okay, so as it gets collected, her basis in the law firm is going to go up by 50% of the amount that is collected because Dave owns the other 50% of it. They're 50-50 partners. So her basis is zero because the accounts receivable have a zero basis. As they're collected, Alyssa's partnership basis is going to increase. Okay, so that's the partner outside basis, inside basis. This is probably the hardest concept to grasp in this chapter, is this inside-outside basis. So what about the partnership basis? So the partnership now is a separate entity and it's got its own assets, right? So because it's got its own assets now, it also has a basis, right? So the basis, like if I'm contributing that equipment that was worth $10,000, I transfer it over to the partnership. Now the partnership has a $10,000 basis in that equipment. It's going to depreciate that equipment. It's going to carry on as though, it's always owned that equipment. Basis in, basis out also applies to the partnership. So assets contributed to the partnership have a tax basis for depreciation and also for gain and loss determination. So just like we had those assets that we depreciated in chapter 6, and when we sell them, chapter 7, we have to have a gain or a loss. The same thing happens with the partnership, but we have to have some sort of starting point for it. We have to know what our basis is to begin with. So basis in, basis out, the partnership steps into the shoes of the partner. So if I have equipment that I'm contributing, let's say so here's mine. The equipment to me is basis $10,000, and I'm in year 2 of depreciation. And I contribute this to the partnership. Well, what happens is that basis transfers over to the partnership, and it's going to pick up in year 2. The partnership's going to pick up in year 2. If it was fully depreciated, it wouldn't transfer. Like, it's a little bit different from, like, if we purchase a used piece of equipment, we still get to depreciate it over the regular life. But if I'm contributing it to a partnership, that's different. So it's just as though it never changed hands. It just continues on in its normal path. So the partnership steps into the shoes of the partner. The basis in the hands of the partnership is the same as the basis in the hands of the partner. So the partner's basis carries over. Let's see, where are we talking about gap here? So here is an example of how what the balance sheet would look like on that company that Bart and Alan formed together. Remember, they contributed $90,000 cash, equipment, office equipment, this truck. Again, the basis of these is the basis in the hands of the partner. So all of that is contributed. And then this is the partner's outside basis, or yes, their outside basis is the equity that's in the partnership. So we've got our assets over here. We don't have any liabilities yet. You can transfer liabilities to a partnership too, though. So you can transfer amounts that you owe to a partnership, but what that does is it reduces your basis in the partnership. So for depreciable assets, the partnership assumes the depreciation schedule of the partner at the point of contribution. So that's what I'm saying. I was in year 2 depreciation here, transferred it to the partnership, year 2 continues. For example, if the partnership partners in the year 3rd year of depreciation, contributes that asset to the partnership, partnership starts depreciating it in 3rd year. If it's a personal use asset, so if a personal use asset is contributed to a partnership and then it becomes business use, the partnership's basis in that asset is the lower of the partner's original cost or the fair market value. So if I had this equipment was not in a business, I just had an oven and a refrigerator and I was using it personally, I'm going to then contribute it to the partnership. I didn't depreciate it, right? I didn't depreciate that equipment. Now what happens is I'm going to look at how much I paid for it or what the fair market value of that equipment is. Chances are fair market value is going to be less than what I actually paid for it, because those types of assets usually depreciate. It's going to be lower of those two items if it was a personal asset item. So here we got an example. Jose contributed a piece of equipment to JWS Partnership on March 1st. The cost of the equipment was $20,000. Year 2024 was the 3rd year of depreciation under 7-year makers. So the depreciation of the equipment for 2024 is going to be calculated like this. So on Joe's Schedule C, because he's going to have 2 months on his Schedule C of depreciation for this equipment. He still gets to depreciate it for 2 months because his business owned it for 2 months. So this is the depreciation expense that he took in the previous years. And then this year, he's going to take 2 months of depreciation on that equipment. So he'll get $583. And then the new partnership in 2024 is going to pick up on the rest of that depreciation for the rest of the year. So it's going to be divided that way. Jose also contributed a truck to JWS Partnership that he had used personally. So this is just his personal truck. The truck cost him $28,000, but its fair market value is $8,300. So the basis to the partnership is going to be $8,300. They're going to start depreciating it. So because it was personally owned, it was never depreciated. So we're not going to start in what would be like the 3rd year or whatever. We're going to start with year 1 depreciation if it was a personal asset. So we'll get to depreciate that for 5 years. So a partnership interest is a capital asset to the partner. So one of those 1221 assets to the partner. Partners are likely to contribute capital assets, 1231 assets, and ordinary assets like inventory. So partners will contribute inventory when they form partnerships. The holding period of the partnership interest includes the partner's holding period if it was a 1231 asset or a capital asset that was contributed. So remember, 1231 assets, those would be things like equipment that are depreciable, whether it was, so that would be 1231 would be if it was held for more than 1 year, and then capital assets are personal assets, items that were held personally or investments. If ordinary assets are contributed, like inventory, accounts receivable, the holding period of the partnership begins on the date of the transfer. So it's going to be a short-term holding period for that. So it'll begin on the date of the transfer. Same holding period holds true for the partnership. So the partnership's holding period for the individual assets will include the contributing partner's holding period for 1231 in capital assets. So let's look at an example of this. So Casey contributed the following assets to CWS Partnership June 5th. So he's got a building that he contributed, has a basis of $175, fair market value of $300,000, and he's got inventory with a basis of $50,000, fair market value of $100,000. So it was purchased 2015, 2019. The building is a 1231 asset, has $175,000 basis to CWS. Basis carries over for the building, right? And it has a long-term holding period. So this is going to be as though they're stepping into the shoes. It's as though the partnership has owned it since 2015. The inventory, however, is an ordinary asset. Its basis is $50,000, but its holding period starts on the date that it was contributed on June 5th. Has a short-term holding period. All right. So in addition to contributing assets or cash, a partner could contribute services. So like Jennifer is going to contribute. She's going to be the one that's baking. She's going to be the one that's actually doing the work. I'm going to contribute the equipment. Anthony's going to contribute the cash. And Jennifer's going to contribute the know-how and the sweat equity, as we call it. So there is, when a partner contributes services, remember I said when assets are contributed to a partnership, there's no recognition of gain or loss at that point when that contribution happens. When a partner contributes services, however, that is not necessarily the case. So when forming a partnership, one or more partners will frequently invest capital and other partners will perform services in exchange for the partnership interest. So a partner that's providing services will recognize income to the extent of the fair market value of their partnership interest. So if I'm contributing $10,000 of assets, Anthony is contributing $10,000 of cash, and Jennifer is contributing, if we're a third, then the value of her services is going to be $10,000 as well, but she's going to have to pay tax on it. That's how then she gets basis in the partnership, by paying the tax on those services. So you will recognize income to the extent of the fair market value of their partnership interest. Here we've got Russell, Kevin, and David form a partnership. Russell and Kevin are wealthy investors. David is an expert construction contractor. Russell contributes a 20-acre parcel of land. Kevin contributes cash. All right, so Russell's got this land. Kevin's got a bunch of cash. David doesn't have any cash or any land, but he's an expert, so he's going to contribute his services. So David agrees to perform all the work to develop the land into a subdivision. So he's gonna have to recognize income as those services are performed. David is going to recognize $240,000 of income in the tax year of formation. How is that determined? Well, they've determined that this is their partnership percentage. This is part of their agreement, that David is going to own 40% of that partnership. So we take the fair market value of the total assets contributed, multiply it by David's ownership percentage, and we come up with how much David is going to have to declare in income, how much he's going to have to recognize in income for his future services. So now he's going to have to come up with tax for $240,000 of income that he doesn't have, right? But he has to declare that. So again, we're going to take the fair market value of the assets contributed and multiply it by the ownership percentage for that partner that's contributing services. And that's the value of their services. Contributed property with liabilities. This is where I said you can contribute liabilities to the partnership. So a partner who is released from a liability, and think about this like you're contributing a building that you have you still have a mortgage on it. So the building's worth $400,000, but you have a $200,000 mortgage on the building. you transfer it to the partnership, and the liability carries over that $200,000. Well, you don't, even though if your basis in the building is $400,000, you don't get that full $400,000 basis because you're also getting release of that liability. You now don't have to pay the $200,000 for that that you owed in that mortgage. So a partner who's released from a liability is treated as receiving money from the partnership. It's as though the partnership gave them that $200,000 because now they don't have to pay it. It reduces their partnership basis, but what it does, that liability increases the basis for everybody else. Or actually, it increases the basis for everybody based on their partnership percentage. So if other partners assume a portion of the liability, they're treated as though they made a contribution that increases their partnership basis. So here's an example of what this looks like. We got Angie. Angie contributes an office building to a newly formed partnership in exchange for a 25% interest. The building has a $300,000 fair market value and a $160,000 basis. So she was just contributing that. Then that basis it carries over to the partnership at $160,000, but it has a $100,000 mortgage. So she still owes $100,000 on it, but now she's not going to have to pay that. The partnership assumes the mortgage. Each of the other three partners contributes $200,000 of cash. Here is how their basis is going to be calculated. So remember, Angie's basis is going to be the basis. It's going to carry over. Her basis was $160,000, so it's $160,000. Each of them contributed cash of $200,000. That $100,000 mortgage is divided up a quarter, a quarter, a quarter, a quarter. So each of them gets to add that to their basis of $25,000 each. But Angie's basis is also going to be reduced by $100,000 because she was relieved of that $100,000 liability. Okay. One thing to note, and this is, we're going to come back to talk about basis when we talk a little bit about S corporations as well, by the way. So a partner's basis can never go below zero. You can never have negative basis in a partnership. Zero is as low as it goes. If the release of the liability causes the basis to become negative, the contributing partner must recognize a taxable gain in the amount of that negative basis. Essentially, that basis represents what have you paid tax on, what haven't you paid tax on, right? And what are you going to pay tax on in the future when you sell this asset? So let's look at the same facts, except that the basis of the office building is $45,000. So instead of $160,000, it's $5,000. What that does is she takes the $45,000 is her basis, add the $25,000 for her share of the liability, 25% of that liability, but we have to subtract $100,000 for the liability that she's released from. Well, that brings her into a negative basis. We cannot have that. So what happens here is Angie's going to have to recognize income of $30,000 from this transaction, and then that will bring her basis back up to zero. So how negative basis is resolved is the partner recognizes gain or recognizes income and then pays tax on that income in the amount of the negative basis. That then brings that basis back up to zero. Now, if she were to turn around, it means that if she were to turn around and sell her share of the partnerships, let's say for $100,000, she's going to have a gain of $100,000 because she has no basis in that partnership. Her proceeds are $100,000. She has no basis that can reduce the gain. So her full gain is going to be $100,000. So the only time a partner will recognize gain on a partnership formation is if you contribute services to the partnership, and then the value of your share of the partnership, which again is the fair market value of the assets contributed multiplied by your ownership percentage. That is going to be the value of the services. You're going to have to recognize gain on that. Or if the partnership is assuming a liability in excess of the basis of the assets. Okay, so you cannot bring that basis down below zero for a partner. All right, so the fun part is, so this is for formation of a partnership. Okay, so we've got this whole issue of what do we start out with for our basis, but remember, basis changes over time, right? Our basis in this asset called the partnership changes over time, and we're going to talk in one of the other sections about what events change that basis over time. And how is it changed over time? So one of the big things about having a partnership is keeping track of partners' basis throughout their ownership of that partnership, because it fluctuates all the time. It goes up and down, and there are lots of different events that happen that will affect their basis.